private equity, it's a fascinating. Nothing's ever the same, right? So you could look at a manager and they have a beautiful track, and if it was so simple as you just looked at the track and you invested, Corey and I would get a lot of rest, and it'd be very easy to do everything that we do. It doesn't work that way. There are new firms all the time. There's people leaving firms all the time. There's a real dynamic ecosystem in terms of the talent. You have managers who are fantastic when they are poor, and as soon as they are successful and they are rich, they are terrible. That is a phenomenon that definitely happens in our industries. They get distracted by essentially their own success, and you have managers who are great at managing $1 billion, and then they're really successful, and then they manage $10 billion and they are terrible.
My name is Adam Myers. I lead the distribution team at Pengana. Thank you for joining us for our PE1 update this morning. I'm shortly going to hand over to Fred Pollock, the Chief Investment Officer and the Portfolio Manager for PE1, and Corey Lopretti, who is a Managing Director at GCM and runs Portfolio Management for Private Equity. But before I do, I want to touch on two key issues which may have brought many of you to this webinar today. And they are the underlying performance of the trust and the current discount to net asset value. Private equity is almost by definition a long-term investment. In 2019, when we raised our initial capital for this vehicle, we detailed our 4-year investment plan to what we called our steady state portfolio, meaning a portfolio which was fully invested, robust, and well diversified. We actually achieved this objective slightly ahead of schedule, but what is clear from this graph is that the returns aren't, nor should they be expected to be evenly distributed. And although the portfolio has returned almost 16% over the last 3 years, and since inception, it has actually outperformed the MSCI World, which has been a very strong performer of late, the performance for the last 18 months or so has been pretty flat. Next slide, please. We have some investors who have found this period extremely frustrating. Over the last few months, we've seen bouts of heavy selling from investors who have probably watched the performance of other investments, particularly the large cap indices, and in many cases, they feel or have felt that they are missing out. We sometimes watch the selling with dismay because the get out at all costs attitude, get out at any price, is certainly not in anyone's best interests, least of all the exiting investors. Although that said, it does provide definite opportunities for the savvy investors on the other sides of those trades. It's also difficult for the Pengana distribution team to generate sufficient new interest to maintain that balance between supply and demand when the underlying performance appears to be stagnating. And we have tried various things to address the selling. We implemented a share buyback and bought back and cancelled a small number of units at levels that were accretive to the underlying performance. And we can and we may continue to buy back units at a later date, but no vehicle ever shrinks its way to greatness. And over the longer term, a larger trust with more units on issue is likely to attract more eyeballs and have better long-term liquidity. And this ultimately means that it will trade at better levels. But as you can see from this chart, PE1 has tended to trade at or around the underlying net asset value per unit. And what we have seen over the last few months has certainly been unprecedented. But I think that this chart really gives the context that what we are dealing with here is a short-term anomaly. Fred will discuss some of the reasons for the recent performance and what has been going on within the underlying portfolio. He will also explain the reasons why he is optimistic about private markets, particularly the segments in which we play. And hopefully he will be able to give you a sense of why he is so optimistic about the underlying prospects for PE1, because I am certain that as we start to see the underlying performance come through, we will also see the current discount start to narrow, and the historical pattern of trading is likely to resume. If you have any questions during the webinar, please enter them in the Q&A box at the bottom of your screen, and we will get to as many of them as possible in Q&A at the end. And Fred, with that, I'll hand over to you.
Great. Thank you very much, Adam. As Adam mentioned, my name is Fred Pollock. I serve as the Chief Investment Officer for GCM Grosvenor and also the Portfolio Manager for the Trust. I'm going to break this into sort of three areas. The first, I'm going to talk a little bit about the markets and the backdrop and what's causing some of the trends we've seen in the evolution of the value of the underlying trust holdings, as well as some of the opportunities. I'll talk a little bit about what this means for private equity, and then finally bring it down to the trust level and what some of the ramifications are for the trust itself before we get to Q&A. Corey Pratty is going to join me, talk a little bit about the portfolio in detail in the middle of that. Before I even get started, one thing I'd probably highlight for those of you of interest, the Financial Times actually ran a fantastic article on private equity this morning that was entitled, "Is Private Equity Actually Worth It?" And they frame this in the context of the Norwegian sovereign fund, which is one of the largest pools of capital on Earth's decision as they try and seek approval to go from a 0% allocation to private equity to a 5 to 7% allocation to private equity. And there's an enormous debate that they bring to life about the value of private equity in one's portfolio, whether it's worth it in the context of fees and some other ramifications, the illiquidity, the fact that the returns are relatively lumpy, and then how the sovereign wealth fund has gotten to this conclusion that it's necessary to make this change, and they're sort of fighting to be able to allocate to private equity. So I would draw everyone's attention there. The other thing you'll notice, which is one of the implications of the article, is they discuss how a lot of larger institutional investors are using more sophisticated ways of implementing their private equity investing, like co-investments, secondaries, and some other types of exposures, to actually get a more efficient exposure to private equity. And what's amazing about that to me is if you look at the constituency of the trust and its investment strategy, those are all strategies since day one that we've been implementing in this trust, and then being able to bring it to all of the underlying investors. And so you sort of, I think the article does a pretty good job of framing the debate. And I think it also brings to life some of the, hopefully some of the value added initiatives that we've been using inside the trust on behalf of all the clients, just like we have very, very sophisticated large institutional investors considering doing. So before I begin, I draw everyone's attention to that. And if you're interested, just spend some time reading it, because I think it's got valuable insights and different links in the debate. So to begin, what has happened? What has caused the change in the return or rate of return that we've seen from private equity for kind of the last 12 to 18 months? Because what you're seeing in the NAV evolution of the trust is not dissimilar to what you would see in the NAV evolution of private equity writ large across the industry. And what is going on? So the first kind of big point is we had a regime change in interest rates that was spurred by inflation getting out of control. So the policy responses, obviously, to the COVID crisis globally, which was sort of a human tragedy and also an economic tragedy. There was a large amount of stimulus poured into the economy, trying to prevent kind of a cardiac arrest in overall economic activity, while we had all sorts of regimes in place to keep people at home or largely at home or partially at home, or in some cases, not crossing borders, kind of globally during that period. That was probably necessary economically at the time, but it had the unintended consequence that it caused a fairly significant surge in inflation beginning in 2021 and certainly throughout 2022. And you could see that here on the left hand of this slide. The good news is, and you look on the right hand of the slide, inflation expectations or the market's perception of the ability of central banks to keep control of long-term inflation really didn't get out of control. So it's sort of a dynamic that you saw in the markets. And I think the marketplace had a large amount of confidence that central banks would do what they thought was appropriate, which was raise rates, short-term rates in particular, in response to the spurt in inflation to try and bring it back down. And they did that. So if you look on the left-hand side on the kind of, I don't know what I would call it, the gray box on the right of the left-hand graph, you'll see inflation has substantially gone down, although it's not at the level, which is the dotted line, which is the policy objective, at least in the United States, for the change in consumer prices. You would see the same thing in Australia, Europe, and most of the developed economies there. Inflation is still running relatively hot and at a level that if in the pre-pandemic period, if we had seen 3% inflation, we would have seen central banks very aggressively raising rates, trying to tamper it down. And so I wouldn't say that we're past this phase at all. And rates have been raised to a point in the U.S., for example, where the short-term rate is about 5%. And globally, if you look, it's sort of in the 4 to 5% camp in some markets. And in the markets where they haven't raised rates quite as much, Australia is a good example of that. Japan is an extreme example of it. You've seen their currency suffer substantially as a result of not keeping up with those higher rates in the US and parts of Europe. If we go to the next slide, a little bit of caution that I would offer is, while this does feel like we're fairly past the inflationary period, and certainly if you read economic commentary, there's a lot of consensus about inflation coming back down and some of the constituent parts coming back down. We don't have a great history globally in modern times of killing inflation the first time we try. And so typically what happens is policymakers feel a lot of political pressure to lower rates prematurely, which then leads to resurgence in rates. And that's certainly been the historic experience in past periods. That's not a forecast, it's just a warning that sometimes we think that we've killed inflation or we've kind of beaten back some of the forces that are causing inflationary impulses, and we're wrong. Right, and especially in times like this where you really haven't had the economic slowdown or consequences you would expect from increasing rates, because you have certain cross currents in the economy, it can cause a resurgence in inflation. And so, we've got our eyes towards kind of positioning ourselves in a way that is relatively neutral. And the way we do that is obviously by buying and making investments with companies and firms where we think they have pricing power and can pass it through. It certainly helped us through this period not lose a lot of capital during this transitionary phase, and we're still a little bit cautious about it. If we go to the next slide, I think a big question we get, and I think this is very important actually for the performance of the underlying businesses, and we'll get to that, and when we get to the end of the slide presentation. Why wasn't there a recession, particularly in the United States, Europe, and some other markets? The answer is we are aggressively spending borrowed money, and so in the United States, for example, we're incremental borrowing or credit creation is almost $3 for every dollar of GDP growth, and meaning that we are funding what it seems like a very strong economy, but is actually a pretty interesting economy that's a function of increasing debt levels. And we could all debate what that means. If we go to the next slide, if we could go to the next slide, please go back, please. Thank you. What do we mean by no free lunch? It isn't just unsustainable, at least in the US. And so, some countries are obviously in better shape. Australia would certainly be one of them. Certainly some European nations are in better. The United States is not in particularly good shape in terms of sustainable path of debt. We're borrowing about $1 trillion every 3 months at the federal level. And then if you look down through corporates and consumers, they're also borrowing at the same time. That certainly helped economic activity, but you just can't keep it up forever. I'm not going to, again, it's not a forecast. It's sort of, if you looked at Japan or some of the other exemplars, people would say you could keep this up for a lot longer than the market thinks. There's a lot of differences between the United States and Japan in terms of saving levels and other things. So I wouldn't use that as a huge point of comfort. And at the point at which this becomes a problem, and net interest expense in the U.S. exceeds, things like our interest levels exceed what we spend on the military, which is an unusual consequence. You can see it on the right of this graph. You're starting to get real world effects of what's going on. And so, one of the concerns we have is just, what does it mean for economic activity? You could have a situation where the spending and the deficit spending has to retrench, and it might lower interest rates and help you on one side of the ledger with your discount rate, but it could really hurt you on the revenue side or corporate profitability as a consequence. So I think we need to keep an eye out on all of these risks on big picture. If we go to the next slide, I want to talk a little bit about what has really happened to markets. If you look at equity markets, they're kind of back to all-time highs. What you really see here is that the real leaders, largely speaking, were the laggards. So the things that lost a lot of value early in this particular regime change, especially things like information technology, communications, consumer discretionary, these are largely high growth companies where the cash flows are long into the future. When you increase interest rates, that discount rate mechanism caused their values to degrade more than other sectors. And then the rebound we've seen in the equity markets as people start to price in declining interest rates, is what you see in the forward curve, has caused those areas to rebound and more. So you had their traditional growth and you added on to it the fact that the market has already decided interest rates are going back down, not to zero, but to more like 3% from 5%. And as that gets priced into equities, you've seen a rebound in those categories. If we go to the next slide, I think an important thing to note, the gains have been really top heavy. I don't think I'm telling anyone on this presentation anything they don't already know, but in the US, at least 7 stocks represent a substantial majority of the gains from the S&P 500, for example, in 2023. You can see there it's sort of a 16% or so of the return. So that's unusual. I'm not even going to argue whether it's sustainable or not. I think we have models on all these companies, as does every investment management firm on earth, and some of them probably can sustain their values and some of them cannot, would be our kind of our prediction. But it does suggest something unique about the market, which is it's pretty concentrated and therefore something to keep an eye on. If we go to the next slide, something we're kind of framed for most clients is starting from where equity values are now in the public markets is not, generally speaking, been a historically good place to think about forward return. And so we're a little bit cautious about what we think of forward return. And you might ask, why do private equity firms care about public equity values? Obviously, there's a knock-on effect in public company values versus private company values. Public exits are a potential option for private companies. Also, to some degree, the world comps between the two areas. And so what's unique, of course, is that most of the gains and the high valuations exist in a type of company, a mega cap company, $1 trillion type growth company that just doesn't exist in the private context largely, other than a few examples. And so I think there's a big disconnect between what's happening in the public markets and happening in the private markets. Or if you would say in the public markets, in the middle market space, things have not really rallied in the same way that you've seen at the top end of the market. And that's really more indicative of what's going on in private equity, in terms of overall value evolution. If we go to the next slide, I think this is starting to bring us down to private equity a little bit more. I think it's a very important slide to understand kind of value evolution and realizations in the portfolio. Global M&A activity is down substantially from the 2021 and 2022 periods. And looking at this graph, you can see on the top, by every measure, deal count and deal dollar value, everything is down. And M&A activity by quarter. You might look at that a little bit and say, well, why is it such a big deal? 2023 wasn't that much worse than, say, 2019 or 2020 or 2018. You have to remember there was almost 35% inflation during this period. So in real terms, it's a more than a decade low in terms of activity, and private equity was even more impacted than general M&A because there was a lot of corporate activity that occurred even in the context of this that wasn't necessarily trade sales associated with private equity. Those realizations are very, very important to private equity. The reason, there's obviously a flywheel. Investors, when they allocate to a private equity fund or private equity companies, they need to exit one to put more capital into the next one, unless net everyone's going to increase their allocations to private equity, which is not something that we've seen. And so, the gears of buying and selling have slowed down a little bit. the ramifications for private equity values are obviously quite real. So interest rates go up, the cost of interest and debt on a private equity enterprise goes up, the value and multiple comes down a little bit, and the transaction activity slows down. And when you have realizations, is generally speaking, when you get substantial write-ups in the private equity enterprises themselves, just as a phenomenon of kind of the marking of private equity, all of those factors are poor, and all of them led to kind of that flat performance that you saw for 12 or 18 months. I think I'd tell you in the context of global private equity, flat was actually pretty good during that period of time. And the NAV benefited a little bit from the degradation in the Aussie currency, of course, during that phase, which is why you see it kind of flat as opposed to down 10% or down 15%, like if you looked at many different private equity indices over that period of time. If you go to the next slide, I'm not going to read this slide to you, I'll comment, but just if you looked at kind of leveraged buyout activity, it's also remained very, very slow. And the fall off is even bigger, as I said, than what you were seeing in kind of global M&A. It's true in every region, North America, Europe, as well as Asia. The good news is we're seeing a real pickup in activity this year. So in early 2024, I don't know whether our team will be right, but if you talk to all of the private equity sponsors that we work with, you looked at a lot of the companies, there's definitely more transactions already this year than last year by a pretty significant degree. There's a lot of things that are on market or signed and looking to close. And, if you looked at the forecast, it would suggest that we may not even be just back to normal, but you might even have above normal realizations over the course of 2024, which eventually we're going to have because we're going to have a normal realization year combined with a little bit of a catch up from the things that didn't sell during 2022 and 2023. And so I think that's a good sign, but I wouldn't make a bold prognostication yet. I'm hoping for a relatively healthy year or an okay year in terms of realizations. And then I would imagine that 2025 and 2026, you'll start to see a real pickup where you had a substantially larger number of realizations in the portfolio. If you go to the next slide, so what does this really mean for the middle market? The area remains pretty attractive. It's obviously a large investable universe. There's a lot of different ways to produce value in that area, which we've always talked about. The multiples are still low and leverage levels are still relatively low compared to the rest of the market. So as I discussed, kind of the high end of the market, the mega caps, valuations are starting to get really stretched. It's not true in the middle market, either in the public markets or in the private markets. You're just not seeing the same level of kind of activity or equity risk premium contraction that you saw in that area. And the breadth of exit opportunities is actually, pretty wide right now. You still have all of the dynamics that made the trust interesting at the beginning. I think one of the things I find fascinating is sometimes people will say, well, rates went up. How is private equity going to work? How are we going to benefit from that? And I remind them that private equity was sort of as an institutional asset class formed in the 1980s and 1990s. That was during a period where interest rates were as high as 18%. So private equity doesn't have anything to do with low interest rates. I think that's a misunderstanding. Obviously, if interest rates decline, all asset prices go up. And if interest rates go up, all asset prices go down. People invest in private equity because they want to outperform the other asset classes. That outperformance is a function of the active management of the underlying businesses, which is a function of security selection. It's a function of control. It's a function of management. It's a function of value creation. It's all about growing the cash flows from the underlying business. Nobody is smart enough to trade interest rates. That's just not what the strategy is about. We do have a lot of partners, and we work really hard to try and drive cash flow accretion at the underlying companies in a sustainable way, and to invest in good companies with moats and barriers to entry that will be productive and grow over time, and that we can exit at higher valuations because we grew the cash flows, not because of these other implications. I think in some markets, when interest rates have gone up over the last couple of years, we're growing the cash flows, and then you're going to get exits that are still a multiple of your entry, and that's despite the cost of capital going up, right? It's not and that'll happen during that period. That's happened in the past. Private equity, was very successful in the late 70s, the 80s, and the 90s. And some people would describe that as the golden age of private equity, actually, as opposed to it was some sort of era where you couldn't participate in the strategy. On the next slide, there's a description of the portfolio, and I was going to ask Corey to join us and just sort of talk through a little bit of the breakdown of the portfolio, if you could. Corey?
And good morning, everybody. So as Fred noted, slide 16 provides some more detailed exposure information on the entire PE1 portfolio across several different metrics. We currently have exposure to over 90 funds, 550 companies, and investments from 20 different vintage years. Committed 500 million to investments, over 70% of which has been funded, and we've seen meaningful distributions from these investments. PE1's already gotten back 90 million in proceeds through the end of January, approximately 10.5 million of which was distributed in the second half of 2023 alone. Overall returns have been quite strong, the portfolio generating an 18% net IRR and a 1.5 times multiple on invested capital since inception. From a sub-asset class perspective, you can see that nearly 60% of the overall portfolio is comprised of leveraged buyout investments, with 2/3 of that buyout exposure in the middle market, which, as Fred just noted, is the part of the market that we believe is particularly attractive. We believe that PE1's focus on the middle market, where managers typically rely less on leverage and more on operational improvements and revenue growth to drive returns, makes PE1 very well positioned going forward in terms of potential for uplift, as well as near-term realization activity. The next largest exposure from a sub-asset class perspective is to growth, either directly or actually more often where possible through investments that included structural elements designed to enhance the performance profile. As I noted, more than half of our growth equity investments were done with these structural protections built in. These elements typically include a component of potential downside protection through the use of a variety of different instruments and terms, things like preferred equity or liquidation preferences. We've been focused on these structured securities within our co-investment and direct sleeve, and have recently seen a number of really interesting opportunities there. One other thing I will note regarding the sub-strategy exposure is that you do not see venture capital, because VC allocations are not a part of the PE1 strategy. Geographically, the fund is 80% invested in North America and has some more limited allocations to Europe and to Asia. This too is generally in line with our targets, though I could see that European exposure inching up a little bit if and when market and geopolitical conditions in the region improve. And from an industry perspective, the portfolio is quite diversified. Industrials currently make up the largest portion at 21%, and several other industries, including IT, healthcare, consumer discretionary, and financials, each comprise a little over 10% of the portfolio. All said, though, we are highly diversified by sector, and that is intentional. Turning to the next slide, this slide lays out some of the different methodologies private equity managers use to determine value of the companies they own. While there are a variety of different methodologies, PE managers use things like comparable public companies and discounted cash flow models to estimate value, as well as all sorts of different types of information. The main point we actually want to get across is that most of their PE managers are not incentivized to take aggressive marks. There are a few different reasons for this. First, management fees are paid on invested capital rather than NAV, and performance fees are typically only paid following exits, not on unrealized value. Second, marks are typically subject to an annual audit by an independent public accounting firm, which would reset the value if the marks were more optimistic than realistic. And finally, private equity investors do not like to see significant unnecessary volatility in their company marks. Because of this, some of the embedded value in a PE portfolio like PE1 will often not materialize until realizations happen. I'll let Fred take you through an actual investment in the portfolio to help illustrate this, and then talk about some of the other opportunities we're seeing in the market.
As Corey said, I'm going to try and use this as a live example to give you a sense of what's going on. So GCF2, which is just an acronym for Grosvenor Co-Investment Fund 2, is an aggregation of a number of underlying private equity co-investments. So I think it's a good snapshot of 23 different companies. Obviously, the trust itself has many hundreds of companies. It's very well diversified, but we wanted to create one kind of snapshot to illustrate some basic points. PE1 committed $53 million Aussie over the period beginning in May of 2019 to the fund. And obviously it drew down that capital over a period. It invested in these 23 different companies over kind of the 2018 to 2021 period. Some of the flags are there. You can sort of see the logo names of some of the companies, which I won't, go through in particular. The real important thing to say is kind of multiple. So first, if you looked at the second bullet from the bottom, I think it's probably the most important data on the slide, which is if you looked across this aggregation of 23 companies that we invested in between 2018 and 2021, LTM, meaning last 12-month revenue and EBITDA, so last 12-month revenue and then earnings before interest, taxes, and depreciation, increased on average 79% and 68% respectively since we acquired these companies. And I'll pause on that because it fits what I was trying to describe earlier. That has nothing to do with interest rates. If you grow the earnings of a company or you grow the revenue of a company 60 to 80% over the course of a 3 to 5 year hold, you're going to make money regardless of what happens to rates. You're going to make money regardless of what happens to your cost of financing. You're going to make money regardless of what happens to multiples within any normal bounds, in private equity. And so that's our real metric. And if you asked us how we think about the portfolio, how we have confidence that it's going to deliver on its return expectations over a long period of time, it's because we're creating value and our partners are creating value at these underlying enterprises. The other thing I wanted to note is that we believe, as many as 5 of these could be realized in 2024. There's obviously been some realizations already, which is the Vera Mobility frame above. Corey mentioned that we've returned a lot of capital. If you look here, we're generating about a 2x net return for PE1 in this aggregation of 23 companies. And we've received about 60% of our capital back, so far at this point in time. And so, when you get through that whole process, the hope would be you end up with kind of a two times DPI or kind of capital invested multiple, and you generate an IRR, which right now is obviously very, very good on this portfolio, but you would hope is in line with our long-term expectations for private equity, which is kind of 18% plus, over that period. And this is looking very good. Why do I raise all these things? A lot of the value creation has already occurred in the underlying businesses, but it's not in the marks. And you won't really see that until the realization happens, at which point all of the kind of factors Corey discussed, you're more likely to see kind of an evolution in the value that is reflective of the evolution in the revenue and the cash flows, of the company over that period of time. And so, as we built up the portfolio over this period, and the overall trust, if you looked at it, really was built up during this period. And so you're having this effect across, hundreds of the underlying enterprises. And we wanted to use this as a live example. If you go to the next slide, Corey, if you could. This is just talking a little bit about kind of cumulative annual performance and something else we track pretty heavily. So the way to think about this is on invested capital. So if you think about when we invest money into the underlying private equity enterprises, you can see that the IRR probably got unsustainably high at one point. Like we can't generate 40% type cumulative IRRs over a period, but it's been more in line with the 20% plus, which is exactly where we would hope on the high end. That is, commensurate with the upper quartile of private equity, which is exactly our target, which is we want to be in the upper quartile of private equity. We like private equity as an asset class, and we want to be in the upper quartile. But the other is, substantial outperformance of the MSCI World, which is the public market equivalent, the PME that we would track against. So if you think about what we're trying to achieve, we're trying to assemble an extremely diversified, portfolio with hundreds of companies. We want those companies to be sort of world-class, have nice moats, produce good cash flows. We want to work with partners and sponsors who grow those cash flows, and we really get our outcomes based on the growth and the success of those business plans over that period of time. Whether interest rates go up or down or sideways, during that period of time, we want that to be the dominant force. We want to deliver on the return targets that we hope for overall in the trust in terms of the NAV evolution. And we want that to outperform public equities, because part of table stakes sort of for people to invest in private equity is an expectation that you get outperformance, during that period of time. And we want to do that in kind of a fee and cost efficient manner if we can, overall, so that we can deliver net to the trust. And so I think that slide is trying to indicate that we feel like overall over a period of time, we're kind of doing that, recognizing what Adam said earlier is obviously completely correct, which is the last kind of 12 to 18 months haven't been as consistent with that kind of long-term performance. It's been a kind of a degradation in the return from a real high point over that period. But I don't think that would suggest that the efficacy out over time isn't going to be true. I think one has to be, relatively patient. My favorite CEO probably of all time as a capital allocator was Henry Singleton, who ran a U.S. firm called Teledyne. And, he produced about a 300% growth in earnings over kind of a 20-year period as a CEO, but his stock price was up 3,000%. And the way that he got his stock price up 3,000% was being relatively smart about recognizing long-term value and doing buybacks when it made sense and selling stock when it made sense. And I suppose my advice about private equity and the trust would be to take advantage of the moments when there's maybe an opportunity to buy discounts, and when there's a premium, one can obviously lighten up what they own, because I think that we have a lot of confidence in the long-term evolution of the NAV, because that's the part that we focus on. And that's how I would think about it from a capital allocation perspective. If we go to the next slide, Corey, just something we got asked a lot, so we thought it would be interesting to throw it in there, which is just what do returns look like when things are bad? Obviously, this is probably not a shock to anyone. If you invest in private equity when things are bad, just like if you invest in private equity or public equity when things are bad, you do better and the returns are better. I don't know that I would say this is uniquely good or bad period versus anything else. I think it's more in the reasonable range of expectations. But I do think the portfolio is constructed to sort of deliver on its long-term return expectations from this point. And then the last slide before we get to Q&A, Corey, just a little bit about kind of the market. I think we've touched on a lot of these things, but the only part I didn't touch on is, rates are higher. Obviously, we talked through all this. The fact that it's a little bit of a tough capital formation market for PE sponsors because of that flywheel effect, because there are not a ton of realizations and therefore people don't have new capital to deploy necessarily. It really creates opportunity for those with capital. And, we have capital in the trust and we have had capital that comes back from some of these realizations and the other activities in the trust. And I think if anything, the supply and demand balance for private equity is even more favorable than it was before. And so to the extent that we can take advantage of that, we will. And then some of the bottom points there, just talk a little bit about credit. As you all know, we had initially said that there would be a component of kind of alternative credit or private credit in the trust. We started out at zero during the zero rate environment, and then we've obviously built that up now that rates are better. And so you can take stock that we're trying to take advantage of all of the different constituent parts of the trust and the strategies that we promised to implement. And we've now done that in that category. And then the secondary market, I will tell you, we've had really great success in this trust so far about opportunistically deploying and investing in secondaries. I think one of the best secondaries we've ever done actually was, as a firm is inside the trust, as one of the LP secondaries that we did kind of immediately following the COVID dislocation. It's been really good. I mean, to the point where I think the IRR is like over 100%, which is not replicable at all, but we've had real good success in the secondary area, and we'll keep trying to do that over a period of time. So with that, I'll just sum and say that, we have a lot of confidence in what's going on, and we recognize people get frustrated with sort of how the security trades overall. Our real focus at Grosvenor is about the NAV evolution and making sure that, we return to that period of kind of mid-teens type evolution in that NAV, while also trying to produce, the annual yield that people have gotten accustomed to and like to experience with the vehicle. And so, if we can get the combination of kind of 10% plus capital growth, 4% yield, functioning properly with the NAV, I hope people will be rewarded for participating and providing capital to the trust over that period of time. With that, maybe I'll pause and turn it back over to Adam just for questions.
I guess my first question is, you addressed the advantages of increased M&A activity, but what is the lag between that increase in M&A and the impact on a diversified portfolio?
Yeah, I mean, it's a good question. So this portfolio was really built up over the first 3 years or so, and kind of 4 years. So if you think about it, we're not quite at the point where the average holding is ready to be sold. We're at the beginning of that process. And so I think we're going to get lucky, sometimes it's better to be lucky than meaning we will largely have missed this period of decreased activity, meaning the period where someone who had built a portfolio 5 years before that might be feeling like the portfolio is getting a little long in the tooth. That's not really true here, meaning I think we'll be in the normal realization cycle, which is kind of the first point. The second is sort of what's the lag? How does it work in terms of turning it back on? I mean, like I suspect that this year we'll have a normal year for realizations, and that next year we'll have a way above normal year for realizations in the portfolio would be my sense. And so I guess it's a year or something like that versus maybe what our normal expectations would have been for the portfolio. And I could be wrong just based on the early, I don't know what we're going to call them, whether they're green shoots or whatever word we're going to use to describe, but the early amount of activity in 2024 is surprising to the upside so far. And so, if that continued for the whole year, we might have an abnormally large realization period, and it might exceed, it might fully catch up from what people didn't sell in late 2022 and 2023.
Okay, that makes sense. Corey, one for you. The dividend, is it sustainable?
Yes, and the way we built the portfolio out over time was designed to layer in investments with different time horizons, different cash flow components to them. And all of that was designed to make sure that not only can we continue to make new investments, but that we would be able to continue to pay that dividend out every single year. And all of the modeling that we do and keep a fairly complicated one for this portfolio looks at how much is coming out, and its multiples of that dividend are expected to come out every year, and that's expected to increase as we start to get into more of that realization activity that Fred was discussing just a moment ago.
Great, thank you. And probably sticking with you, Corey, there was a point made that investments made during recessionary periods tend to outperform. We raised some capital, in an earlier dislocation. How much capital was deployed during unfavorable periods? And do you have a sense, if we look across the vintage exposure, what proportion of the portfolio was invested during favorable periods relative to potentially periods that were less favorable?
Yeah, no, that's a good question. And I think because with private equity outside of deals, right? So we invested in private equity funds as well. They deploy over a period of time because we wasn't a very long recessionary period. If we even hit one during COVID, it was relatively short-lived. But I think Fred alluded before to that secondary that we were able to purchase at I think it was a 45% discount to NAV, taking real advantage of that dislocation. And that was a $50 million position that was very highly diversified. That was really able to take advantage of that time. Plus, a lot of the primaries that we deployed capital to throughout the life were cautious in deploying their capital. And so they still are sitting on capital on the sidelines to some extent, and have been in the process of deploying that into what is likely a better environment to be buying things, in businesses at lower multiples coming in. And so as they come out and they improve these companies, they should be able to get a nice bump on the other side.
Great. Next question. I'm not sure who it is better placed to ask it, but we have seen particularly in some local portfolios, some examples of big PE losses. Accolade is an example of that in the Australian market, where the debt equity ratio was well out of whack and it ended up in losses. Do you have any positions in the portfolio that are keeping us awake at night, or any significant positions is probably a bit to phrase it?
Maybe I'll take that one. So nothing keeps me awake at night, and certainly not in this portfolio. So, we have almost 500 companies in the portfolio, and it's incredibly well diversified, and no one of them drives the outcomes, plus or minus. So really the risk management frame, I think the right perspective is to then worry about correlation. So it's worry about, is there some aggregation or factor running through the portfolio that would be an exposure that would drive kind of a negative risk event, and not idiosyncratic things, meaning it's not like someone invents a new, something new or does something else. So I think the way you frame that is kind of the right way to frame it, which is there's something like a debt effect or a leverage effect or a cost of interest or an exit multiple or an economic factor or currency factor, something like that. We monitor all of that pretty carefully across the portfolio, and none of it worries me. Meaning, I'm not worried about a recession. I'm not worried about rates where they are. If something that I think it's a modern feature of private equity, which was not historically true, is that the average equity contribution to a private equity deal today is about 50%. And so I think of everybody thinks it's barbarians in the gate in like the 1980s, and they've got some vision of somebody putting $1 down and then getting $9 of debt and taking over a company, and oh my God, it's 10% equity. That's not what private equity is today. Private equity is 50% equity plus typically, in these transactions. And in the middle market space, it's maybe even more than that. And the multiples are pretty unchallenging, and the leverage levels are pretty unchallenging, such that it can survive all sorts of different periods. So no, I don't think any of that's really true. And then there's always going to be, out of 500 companies, there are a few spectacular stories where like great things have happened that you couldn't possibly have forecast, nor would we ever try and take credit for. And then there's probably a handful of things where just bad things happen, right? Some regulatory change or some nature of some customer that they had kind of in it. But other than some basic normal distribution of idiosyncratic activity, I don't think there's anything that worries me. I don't know, Corey, if you agree, but I don't really think of anything across the portfolio that really worries me in that way systemically.
No, I completely agree, Fred. And as you mentioned, I mean, 500 companies, nothing's over 4% of the entire portfolio, and even those are companies that have sort of run up because of good value being built into those companies. So I think it is well diversified by intent, and that will protect in the downside.
I'm quickly going to ask a question now about can you explain leveraged buyout being 60% of the portfolio? Is that companies that PE1 acquired through increased leverage? Because I think you made a bunch of relevant points in the last response, and you may want to just add briefly to those in responding to this question.
Yeah, maybe I'll take this one too, Chris. So these sub strategies, like at the end of the day, we all talk that what these are businesses, and they're businesses acquired in kind of different frames and different assets. You have to create kind of a nomenclature that is common across the industry. And buyout is I actually kind of poor nomenclature that was created back in the 80s, because it was an LBO. Typically it was a management buyout, right? That's like the typical frame. So it's language that kind of describes quite simply a private equity investment that involves probably a typical 50% equity, 50% debt capital structure. The debt capital structure will have tranches. And by tranches, I mean, there's a senior tranche, which is normally a first lien, there's a second lien, or it's called a unitranche, meaning it's a combined, feature. It is uncommon to have that much additional debt in the structure. These are not highly levered transactions by any standard. So if you looked at the middle market companies on market or the public companies, the level of leverage is very similar between the two. The real difference between the private market and the public markets is control. You have an equity sponsor who owns the majority of the equity, if not 100% of the equity in the private context, which allows them to control the enterprise. It also means that they are heavily exposed to the outcomes of that company, which is just completely different than the public market context. The other sub-strategies that you'd see on that list, things like structured equity, growth equity, special sits, which is essentially credit, real estate, and other, I think are self-explanatory. Those are just different versions of investment in different types of securities or in different kind of categories or asset class. All the rest of it, when we say buyout, just means your average private equity transaction.
Great, thank you. A question here about the PE commitments that we have made relative to the amount of cash we have on hand. Are we concerned about funding our commitments? Maybe you can touch on our credit facility as well.
You want to take that one, Corey?
Yeah, sure.
Yeah, please do.
So no, we are not concerned about funding our commitments. So everybody else should sleep well at night as well. We very carefully built out our liquidity model for this portfolio. And while you have some assumptions in terms of realization activity in the portfolio, we have done it in a very conservative way. And the credit facility itself that was put in place was really used as a backstop and not as a method of driving further commitments. So we are quite confident based on what we're seeing in the portfolio today and the level of realization activity that we expect to happen, as well as the amount of credit we have on the line, that we'll be able to continue to fund our investments and continue to make new investments. We made our last new investment into our credit fund at the end of last year, and we will continue to make new investments throughout this year and beyond as we continue to try to find new opportunities within the current market.
Yeah, maybe I'll add to just pointing out the basic market dynamics is probably helpful too, which is for every PE buyer, there's a seller. Most private equity transactions are literally amongst private equity firms today. So whenever anyone talks about, you'll see a lot of news articles about dry powder, and they'll quote these huge numbers, and they'll say there's all this dry powder out in the market. And then all of these things, like there has to be a buyer and a seller. So our capital commitments to the funds, and we are essentially, if you looked at PE1 Trust, given that there's 500 companies, a ton of different sponsors, is very representative of the private equity market as a whole. If you see a step up and really see those commitments draw down, it means we have a bunch of realizations. And so they go hand in hand, during that period of time. And so it's not really like, it's just not an event that you ever really see kind of in the marketplace in terms of those two things going out of seven. It's exactly what you see in the portfolio, to be honest, which is you've seen a slowdown in terms of the draws of the capital, and you've seen a slowdown in the realizations. My hope is that with this pickup in realizations, we're going to see a pickup in the commitments being drawn, because we want to get that capital back to work in new opportunities, as quickly as possible as that comes back.
Cool. I'm just going to rapid fire ask a few. Does the fund invest directly into companies or only via other managers? Corey,
yes, it has some
you want to
direct,
go, Kurt? Yeah.
I'd say yes,
Yeah.
it has some direct investments into companies. We are typically doing it alongside a private equity sponsor, but there are some ones that we are doing directly ourselves as well.
So those are in our co-investment portfolio. Confirming to the person who's asked another question about dividends, yes, Corey has addressed that the dividends will be maintained. There is another question that I think we can quickly answer here. The fund doesn't invest in venture capital. Fred, do you want to just touch on the reasons why not?
Yeah, I mean, venture capital has a very different risk profile. Obviously, the loss ratio is higher. The return expectations can be higher, but I think when you adjust for losses, it's actually not very different than the returns from growth equity or private equity, obviously, because if one category had far higher returns, everyone would just invest in that category and it would normalize. So there's not really a return advantage. It's really just a different way of investing in the portfolio. And it's not really our strength as a firm or network. So where we're very, very strong is middle market private equity, and we're very, very strong as growth equity. And we have those categories of investment, but we don't really do a ton of venture.
Great, thank you. Next question I think is interesting. Are there any managers in the portfolio whose performance is under critical review?
I mean, always. The answer is always. So meaning, first of all, it's private equity. It's a fascinating. Nothing's ever the same, right? So you could look at a manager and they have a beautiful track, and if it was so simple as you just looked at the track and you invested, Corey and I would get a lot of rest, and it'd be very easy to do everything that we do. It doesn't work that way. There are new firms all the time. There's people leaving firms all the time. There's a real dynamic ecosystem in terms of the talent. You have managers who are fantastic when they are poor, and as soon as they are successful and they are rich, they are terrible. That is a phenomenon that definitely happens in our industries. They get distracted by essentially their own success, and you have managers who are great at managing $1 billion, and then they're really successful, and then they manage $10 billion and they are terrible. There are managers who nothing has changed, and they just go from good to great, and you feel really good about the decision to invest in them. You have other ones that go from great to terrible for no real reason. And deciding when to get off of the ship is probably more important even than deciding when to get on the ship, because it's pretty easy to see who's successful currently. It's sort of the turn that is hard to forecast, and everything is under review all the time. The ones who are doing well and the ones who are doing poorly, and it's all getting scrutiny constantly. So I think the answer is all of it. And it's a deceiving concept, which is weeding out your losers isn't how you make a lot of money in private equity. It's compounding the winners and sticking and like growing the money and compounding the capital is more determinative about kind of the end state. So yeah, we focus on both, but who's doing well and all the rest, and try and have persistence.
I like that. That makes sense. We are running out of time. I found this conversation extremely interesting. I hope you did too. Thanks very much to our presenters, particularly thanks to people who asked questions. Lots of people asked multiple questions. Unfortunately, we didn't get to all of the questions today. There were just too many, but we will respond to you directly if we didn't answer them. And big thanks to everybody for joining us today. If this was held in person, our audience would have filled a very large auditorium today. So thank you for your turnout. Enjoy the rest of your day. And I hope that this has given you some confidence in the prospects for PE1.